lights are on.
All right, and we're back.
Okay, so I have this theory. It's completely anecdotal, unsubstantiated by any actual evidence, purely based on my conception of the world. But I have this theory that modern finance, the financial industry, finance professionals have a completely backwards way of viewing returns and allocating capital.
Welcome to the Your Life podcast, where we talk about how to integrate the virtues into our life and our finances. My name is Anthony Delazari, Associate Investment Advisor.
Sean Gregory, Portfolio Manager.
AJ Sanson, Associate Investment Advisor.
We are with Servium Capital at I Private Wealth, and our goal is to serve you so that your finances may serve your goals and your goals may serve the good.
Today's modern finance approach to the problem is it's totally rational. It makes perfect sense, but it says, what do we want? We want a high risk-adjusted return. We want the most return for the least amount of risk. And how do we do that? And we take that as the goal, and then we work backwards. And we backtest, and we find statistically significant strategies and factors and ways to splice and dice capital markets and assets and how to allocate our money to achieve this primary goal of maximizing risk-adjusted returns. And I think that's completely backwards. It's totally rational, logical, and the ways that finance is found to do it can work when they work, but I think it sees the problem completely upside down. So my view is it's a good goal, but that goal is a byproduct. It's not the end in itself. I think this is the way it used to be, and this is the way that makes sense to me, is to ask the question first, how do I allocate capital well? How do I do this in the most prudent, well thought out, careful way, being a fiduciary, responsible, reasonable person, exercising professional judgment? And I think if you do that well, you end up in the same place, satisfactory returns for the relative level of risk you've taken on. But the emphasis is completely different. Any thoughts on that before I go on? Okay.
No,
Edit that out.
I have ideas. I definitely have ideas.
Okay.
I just want to see if AJ wanted to say anything first. We played nod tennis there. Yeah. Oh, no. AJ, go ahead.
I don't know if it relates exactly, but I think of the other way in which it's commonly spoken about, especially when people focus on like the financial plan. Ideally you're starting off with their goals and then trying to figure out what would be a reasonable target rate of return attributed to accomplishing that goal. But what your proposition is to look more, I'm presuming, the underlying investment process, more of the how monies are allocated first, and then looking at the returns afterwards or at some point in time? Please, I'm trying to understand.
It's not wrong to think about returns. It's not wrong to think about what is your required return. And in fact, people should think about that. They have a certain goal. They have a certain amount of capital. They have to get to a certain place. What kind of return do you need to get there? But when it comes to equity markets, the stock market, the returns are unknown in advance. And we have all of these, historical methods of trying to forecast and predict what we think they will be as best as possible, but they're completely unknown in advance. So the modern view, I think, is almost like the alchemist who tries to transmute gold out of all of these other things, right? Like, I want gold, so I'm going to work backwards, and I'm going to try to figure out a way to manifest it from these things I have at hand. And I just think it's the wrong starting point, is my most essential point. not that it's the wrong place to be or wrong thing to want, but I think there's a better way to get there. And I think the better way to get there is the way that people used to get there, which is to think about, what am I investing in? What does the company do? Do I like what they do? Do I think they will have a good future? What's the price I'm paying? Is this a reasonable price for the relative business risks and opportunities that they are taking on? And if you do that well, you end up with
the appropriate good return.
Right. So I was listening to a quantitative investor, and he was talking about his various factor exposures, which is how we can think about different components of a company. And they own thousands of businesses that are geared towards this specific investment factor. And he was saying they don't even know what companies they own. Like somebody does somewhere along the way, but him at the head, he doesn't even know where the money's invested. He knows their factor exposure, but he doesn't even know the companies.
Right.
Which is
they
like,
prioritize the return first.
yeah,
as opposed to the underlying
because he's
company.
saying, I want to get to this level of risk. I want to get to this level of return above the market. And where my money actually goes, like who's actually using it on the ground, I don't even know. And to me, that just seems, to me, I think that is completely backwards. Anthony has thoughts.
Yeah, no, I think it takes a view of the human person and of what financial markets are to be merely economic, I'd say, right? Like if your whole...
More than that,
Yeah.
don't lose that thought. It makes it totally self-serving.
Yes. And I think that's what I mean by like totally economic, right? Is that you're going into this marketplace only to see what can I get out of it.
Yeah.
What's
This
the most
thing is a tool for me to do this one thing, and that's it. I don't
Yeah.
care about anything else.
Yeah, which I think comes as a product of a very individualized society, which is not to say, I don't want to get like into this because I think sometimes when this can be brought up, people are like, oh, so you don't care about returns. No. It's like, what's the best thing to say about this? It's like you don't go and date a girl thinking on that date, am I going to marry you? Right? That marriage is a result of the love between the two of you. You have to focus on the love and then marriage comes after. If you put marriage first ahead of love, then you've kind of misunderstood what love is in the first place. Like marriage instantiates love. Does that make sense? I don't know if I could cut this whole part.
I think it
okay.
does. Yeah.
Sorry.
I don't know if it's the best analogy. I'm trying to think of.
Okay.
I'm going to practice this. I don't know where it's going.
Look,
It's
give Anthony
shooting
another
from
shot.
the-
Give him a shot. Give him a shot.
Well, because the extremely crude example of that is to say, this is like for our discussion. Like the very crude example of this is to reduce marriage to sex, right? It's to say like I just want this thing for me, right? I want like the minimal amount of effort that you're going to stay around for here like as long as I can. But okay, back to I'll cut this. So maybe I have to figure out like a different way of approaching this. But I think that the return first idea of markets reduces the markets and the person merely to something that is only worth what it is economically, right? It reduces the person to
No, not economically. It reduces this only to money.
Yes, yeah, that's what I was sorry in my head. That's what I mean by economically. But it ties a person's worth to what they have accumulated for themselves, which I don't think is compatible with the true dignity and value of the human person. But when you take that view of the human person, that is, you are worth what you can accumulate for yourself, then you view everything as a transaction, and especially you view any sort of market as a means for making a return, as opposed to
Sorry, go ahead.
yeah, as opposed to a means for, if we go back to who is the human person, if the human person is somebody who's created to do good, then the market is a mechanism, and that's actually an extremely efficient mechanism for doing that. Now, what do I mean by doing good? Instead of thinking, what can my money do for me? You have to think, what can my money do for the world? How can I put this capital to good use? And as a result of that, returns will follow. But if you only think, I want returns, you've reduced yourself to, you probably put your comfort and security into what those returns are going to be as opposed to your character. So you've reduced yourself to a mere materialistic person as opposed to somebody who has any sort of transcendental or, I guess, character aspect.
Yeah, and it doesn't even have to be transcendental. It just has to be thinking about things other than this is a money machine to make me rich.
Yeah.
It's just about thinking beyond yourself.
Yeah.
And I think it leads to that line of thinking leads to very poor behavior.
Yeah.
Because if this thing is just a gambling machine,
money printing machine,
a place to just I put in money and more money comes out, and that's it. Yeah, it leads to really poor decision making. It leads to chasing, whatever the latest fad is, chasing whatever works. It leads to people being blind to, companies that are doing things that are. I'm trying to think of the most politically correct way to say this.
By definition, unsustainable because of how they treat the human person. How about that? Like a company who's just treating its employees terribly.
Yes. Okay, there's that. I mean, I'm thinking of
unsustainable companies.
Yeah. Unsustainable, or like business models that don't make sense, or, like WeWork was this example of this giant company that people were so excited to invest in, but never made any money. And you go, well, what is the point of that? Or there are these companies that aren't doing things that are very useful, but people will plow money into because they have this view that this is going to be the thing that makes me rich. Or people that are willing to look past rational analysis because my friend's invested in it, he's made a ton of money, this other person's doing this and they've made a ton of money, therefore I will do the same thing, even though it's trading at some unreasonable valuation multiple with expectations that are completely unfeasible. And that's how people have very, very poor experiences trying to invest.
Yeah, no, I'd agree. There's a reason why it's said that love of money is the root of all evil. Again, if we kind of take St. Augustine's definition of, well, what is evil? It's not a substance in itself, but it's a privation of the good, right? Investing with returns first. It takes this view of love of money, right? But then why is it bad? Well, because you don't care about where it's going. You're not trying to put it to any sort of good use. So you've negated, well, for starters, you've fallen into the vice of likely pride, or the vice of vanity, of vainglory, of wanting something that is not what you should be wanting. But at the same time, you've also neglected the good that you're capable of doing, which again, isn't to say don't think about returns. It's just to say, don't think about returns first, because if you are thinking about returns first, you are only valuing your investments for what they can give you, which I think is a very backward worldview to have, because by definition, you're only thinking about yourself. And if that's how you view your investments, then that's not the greatest thing.
And the world is cyclical, the economy is cyclical, businesses are cyclical, and inevitably everyone will go through a period in their investing lives where there's a downturn. It is a fact. It will happen. And if the only reason the only thing to hang your hat on is positive returns, at the first sign of any difficulty in achieving that, you'll be heading for the door, right? As opposed to thinking about, look, I own these companies. They're doing useful things for the world. They're making people's lives better in this other way. It makes you a better investor because it gives you resilience to go through what are inevitably going to be downturns in the world.
I think it's curious when you put the investments first and don't care of how it was created. But to your point, Anthony, it really fixates it on what can I get out of this, and makes that the priority. And then you lose sight of what you were mentioning, Sean, is that, hey, give due care as to what this underlying company that's producing these results, understand that, appreciate that, understand the contribution that's giving to the greater whole, to the world. What good is it producing? I think people can fixate on just the returns when things are going well, when it's producing that return. But I think when things start not going so well, they either quit that, find something else that produces the return. But ideally, you're going back to what did I really invest my monies in here? Did I really give that educated thought? Was that really, truly a good investment? And I guess what our proposal is, let's skip all that. Let's start from the beginning as to are these really good companies that are contributing well that can result in good returns?
Yeah, and I think an interesting thing to bring up there is the idea of unity of life, right? If you want to be the best version of yourself in any area of your life, you want to do that everywhere. Like the moral axioms that you act off of should be made universal, not just for everything in your life, but for everybody. And so if you're viewing the markets purely as a means of making a return, think to yourself, like, is this the best way to look at life? Well, what if everybody took that mentality and that view into life? Would I want to marry a woman who just views me for what I can produce for her? Likely not. Would I want to have a business partner who only cares about the return that he can make for himself? He doesn't care if, I'm a good person or if what we're doing is interesting, right? When you take that view, it's not a very iterative or it's not a very universal maxim to operate out of, which some psychologists will say you can do. Like that's the idea of egoism. But again, we come from a very different perspective where the human person is meant for greater things, that the human person is created to love, right? Which is to will the good of other. So by thinking, oh, I just want to invest for myself, well, you're not loving, you're being extremely selfish, right? You're willing the good of self for self. Like it's the double, it's the self for self. Whereas when you're thinking, okay, what can my money do for the world? How can this capital be put to good use? You're thinking, I want to will the good of these other companies for some other productive use, right? Chances are it's going to come back onto me at some point. And then, in our experience, the returns have been able to follow from that. But you have to first think about, who am I, right? What is my money capable of doing? And then what are the companies that I invest in capable of doing? As opposed to, who am I? I want money. Okay, the markets are now a means of making money. And I think there's actually a lot of inefficiencies in the market because of that, because of how much passive investing there is. I think, and I went through finance school, like everybody says, oh, like the markets are so efficient because as soon as information is out there, it's immediately in the stock price. So you can't actually beat the stock price. Yeah, like the whole weak form, semi-strong form, strong form, efficient market hypothesis, all that. I think that when people reduce the markets to a means of making a return, it actually makes it extremely inefficient because they don't care about what they're owning. They only care about the fact they're making a return. And so they don't actually look at what is this company doing in the long run.
Yeah. Well, what happens is this collection of businesses is reduced to this one thing, the market.
Yeah. Yeah.
And then people stop paying attention to the individual companies and what's their valuation, what's their opportunities, what are they actually doing, and they just think about this single entity, which is, I'm using air quotes, the market. The other thing, we kind of touched on this, I'll just go back to it, that I think is wrong, backwards about this view of returns first, maximizing returns first, is what you're saying, Anthony, about it being prideful. Because it says, or implicitly it says, that I can control this thing, which is inherently uncontrollable. It's unknowable ahead of time. It is unpredictable ahead of time. And so why would we prioritize first trying to achieve some number that is before the fact unknowable? Like that's where I think the whole thing breaks down. Is your first premise is impossible, but like so much time and effort and analysis and research goes into thinking about how to solve this problem. But it's like the alchemist. You cannot turn aluminum into gold.
Well, I think a lot of the markets recognize that, and that's why any sort of managed product is benchmarked. Wouldn't it be, right? Because they're not saying we're trying to chase returns on an absolute basis. We're trying to chase returns on a relative
to
basis.
the market. You're right.
Yeah.
You're right.
Yeah. So like this is all that we care about. Right? It doesn't matter if we get like 7%, 5%, 10% this year. What matters is, did we beat the index? Did we not beat the index? By how much? And our bonus incentive is going to be based off of whether or not we beat it. So the market can go down 30%. If your fund only went down 25%, you beat the market by 5%. Congrats. Mm-hmm. Where your clients are still like, we lost 25%. What the heck? Mm-hmm. And it's because it takes this returns first. Well, returns based to what? Well, the market, because that's what we have to try and be beating. Yeah. I don't know if that's necessarily.
It does.
Yeah.
Whereas I think if a person takes what is the old school way of looking at this, and you focus first on the business and you focus on controlling the things that are controllable, like what does this company do? Is this a useful thing for the world? Is this price, in my estimation, fair for what I think this company can do? Like, Those questions are much easier to answer. And if you can focus your efforts towards that end of the decision, and if you can do that well over time, you do end up doing this other thing of, I don't think outperforming the benchmark is a worthy goal. If you focus your time and effort on thinking about this company, who am I giving my money to? What are they doing with it? Is this a fair price? You get to the same place. You get to the place of, I ended up with returns that I was rewarded with, right? Because these things are a byproduct of doing this other first thing well.
Okay, my thought is kind of related.
Yeah.
But I'm just kind of thinking of the index discussion where everything is kind of benchmarked towards index. I think it's commonplace in our industry. It's like we're kind of teaching the general public, hey, returns should be important to you, should be the primary because you need to produce X return. And so people become fixated as that's essentially the goal because that's where everything is measured against. As opposed to, and I'm borrowing from G.K. Chesterton, what the argumentation we're presenting here today is that element of where common sense is no longer common. And in essence, hey, let's actually go back to the root of investing, which is where you're putting money. You should kind of understand where it's going into, and you're supporting a business. Ultimately, you're supporting a business that you see future outlook that is positive, that you also get to be rewarded from the returns that produces, is a production of those services or goods or sale of whatever product. So it's a calling back to that, but it's hard to remind ourselves of, hey, we're actually investing in companies when the general industry is saying your return should be this based on an index.
Yeah. Well, I even heard like the definition of virtue is like understanding how to use gifts properly, right? So if you have things, you need the virtue of temperance to know how to use them properly, how to order them rightly. Same thing with the market. The reason why companies trade publicly is so that they can acquire capital and invest in their people, invest in their product, and do more of what they want to do. To reduce the markets to merely a means of making a return is to really put the carriage before the horse, because you're no longer thinking about, is this a good company? Is this going to be a productive, good use of capital, which will then generate a return? You're just saying, nope, I just want a return. I'm just going to throw money into the market and hope that it comes back. And I think, like so many behavioral anomalies can be explained by that idea of, I want returns first. I'm going to get stressed out. I'm going to pull my money at a bad time. I'm going to invest at a bad time. I'm going to have this fear of missing out. Why? Because what am I afraid of missing out on? Not the goodness that this company is doing, but the return that this company can produce. And you reduce not only the markets, but also the company to a mere means of creating a return. And obviously, when you have that backwards view of the markets and the company, you're bound to make emotional and psychological mistakes.
Mm-hmm. It also brings up this other skewed perception that can happen where you can make a decision, you can make a good decision, and you can end up with good returns, but you can still look back on that and say, but I did less than the market, therefore I failed. Which is, it's almost as backwards as saying, like, I outperformed the market when everything was down, therefore, like, I did a really good job. Like, really? Yeah, and as opposed to what you're saying about virtue and using the gifts that you have, the whole premise of passive investing says that, look, on a repeatable basis, after fees, the active investor, statistically cannot outperform the benchmark. Therefore, I should just invest in the benchmark, which says, look, I'm going to give up my ability to think just to get the market return.
And then prioritize the return, which is...
Because you just put in the return first. You just, like, I can't bear the thought of underperforming the market, the risk that could happen, therefore I will just own the market. I don't know what companies are in the market. I don't know what they're doing with my money. I don't know what they're doing with the world. But all that matters is I just get the market return.
And the curiosity is that that's happening on a large basis in our industry, is that everyone's just moving towards this passive approach of things. Yeah. Where I guess more of the active approach is now more the scarce.
Yeah. And I also think it's incorrect. Sorry. Less correct. No. I also don't agree with the line of thinking that says I am going to be very active in my security selection just so that I can outperform the market. I think I have more skill, and I think I can do better than the index. I also think that's in a
The two opposite
Yeah.
circumstances.
yeah.
Yeah.
I think it's like completely the wrong. It's still putting returns first. It's still putting the cart before the horse, instead of saying, what companies do I see that are interesting? Who's going to use my money in a way that I think is useful to the world? And thinking about how this can be useful for things beyond just myself.
I like it. Anything else to add?
No, I think that's it.
Brilliant. Thank you for listening. I'm Anthony.
I'm Sean.
Hey, Jay.
This podcast has been prepared by Sean Gregory, who is a portfolio manager, AJ Sanson, and Anthony De Lazari, who are associate investment advisors for IA Private Wealth Inc. Opinions expressed in this podcast are those of the portfolio manager and investment advisors only, and do not necessarily reflect those of IA Private Wealth Inc. IA Private Wealth Inc. is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. IA Private Wealth is a trademark and business name under which IA Private Wealth Inc. operates.